Good morning, everyone. So today is the third day on financial instruments, and we were in the basic part of the definitions itself. So if we revisit what we have done so far, as far as I recollect, we had completed everything about financial liability. So what is a financial liability? It is a contractual obligation. So all statutory obligations go out of the purview, lawsuits go out of the purview because they are not contractual. They are merely statutory obligations. So a contractual obligation to deliver cash or another financial asset to another entity. So that is the first part. Second part is to exchange financial assets or financial liabilities with another entity. All right, we have seen that under conditions potentially unfavorable to the entity. So these are basically options where you are the option writer. Okay, then so this is the first one. Or a contract that will or may be settled in the entity's own equity instruments. We saw this also. Provided if it is a non-derivative, it would be obliged to deliver a variable number of own equity instruments. Or if it is a derivative, then if it fails the fixed for fixed test, it becomes a financial liability. If it passes the fixed for fixed test, it goes and sits under the heading of equity. So this is what was discussed about financial liability. Then we move on to what is a financial asset. It is cash, equity instrument of another entity. Contractual right to receive cash or another financial asset, we have seen this, or to exchange financial assets or financial liabilities under potentially favorable conditions to the entity. So this is the example of an option. Or it could be a contract that will be settled in entity's own equity instruments. This part is what we were supposed to be doing. I told you I'll be taking it today. That is D1 we have done. We now move on to D2. Any doubt so far? Anyone? Any doubts? No doubts? Okay, good morning, Miss Nikita. Good morning, Mr. Viraj. Good morning. Okay, so now coming on to the next part, that is financial asset. This is D2. This is D2. Okay. Others are there. Who are the usual ones? Shriram is there. Janvi is there. Are you guys all there? Yes. Okay. All right. Fine. So now let us come to D2 of the financial assets definition. So you'll be able to then understand the whole intention behind having such a definition in your standard. Okay. So now let us look at a particular case where you have an investor who has invested in Startup Limited. Okay, you have an investor who has invested in a startup company. Let us call it as S Limited. Okay, now all these investors have one fear, and that fear is how will they recover the money from the startup which they have invested? See, the whole purpose behind investing is so that you get a good return. The return could be in the form of stream of dividends or income, or it could be in the form of ultimate return of your capital. So normally investors, when they make an investment in a startup, the important clause which they look out for is the exit clause that is there. So the exit clause could be a clause like they could say the startup will come out with the initial public offer after say 3 years or 5 years. And at that time, the investor will liquidate his holdings and realize the capital that he has invested. So this is one form of investment. However, if the business is such that we are not sure what will happen in an IPO, as we all saw that IPOs like Paytm went into a disaster. Okay. The moment it was issued, the prices crashed, and then what was the price ultimately you thought should be received was not received. The markets did not respond well to the Paytm business model that was shared by them as a part of the prospectus. Okay. Nevertheless, so investors have a fear that their capital may never come back to them. So what investors do is the investor will enter into a contract with the startup company itself. The investor will enter into a contract with the startup company itself. So let us assume I have a startup company, S Limited. S Limited has invested, has equity share capital of, let us assume, 10,000 shares at rupees 10 each. So this is the startup equity share capital which is there in the entity, and then it is received from various investors. It is received from various investors, and then you will be having certain securities premium also. Okay, so this is what is there in the balance sheet of S Limited. Now the investor, see, I am in the books of the startup. Okay, so be very clear about that. The investor enters into an agreement with the startup entity saying that after 5 years, you will buy 5,000 shares from me. Okay, that means you will essentially perform a buyback. After 5 years, you will buy 5,000 shares from me at rupees 200. Okay, let us assume that the initial issue price was 100, so you are buying it at 200. So securities premium at 90, so 10 plus 90 is 100, and then you have entered into a contract with the company. Investor has entered into a contract with the company ki bhai after 5 years the startup will buy back the investors 5,000 shares at the rate of rupees 200. So initially it was put in as 100. So 100 means the return on investment is doubling after 5 years. So this is the contract which is entered. This is the contract which is entered. Now I want you to tell me the total equity shares in the startup is 10,000. The total equity shares in the startup is 10,000. But what I want you to tell me is, what do you think about these 5,000 shares? What do you think about these 5,000 shares? Are they meeting the understanding of equity that we know, or are they meeting some other understanding? Okay, do you think these 5,000 shares have the same risk as equity shareholders, or do you think that they come under a privileged lot where they are getting a guaranteed return? What do you think? What do you think? Yes, Kaushiki is right, but others, what do you guys think? Do you think that these 5,000 shares which the startup has purchased at the time of investing, and now he's saying that after 5 years you buy it back from me at 200. So tell me now, do these shares, these 5,000 shares held by the investor, are they really equity in nature, or are they not equity in nature? Okay, so understand what is the meaning of equity. Sir, equity means evidencing a residual interest in the assets of the company after deducting its liabilities. So any instrument that evidences a residual interest in the assets after deducting liabilities. So that means residual interest in the net assets. If I look at this agreement, I do not have any residual interest as far as these 5,000 shares are concerned. I means who? The investor. The investor is seeking a guaranteed return on these investments. The investor is seeking a guaranteed 200 rupees per equity share on this equity shares which it is owning. So basically, out of 10,000 shares, 5,000 shares are not in the nature of equity. Why? Because they are not evidencing a residual interest. I'll do one thing. I will just make it 4,000 so you will be able to understand it clearly. Okay. So out of the 10,000 shares, 4,000 shares do not evidence a residual interest. So no residual interest, no residual interest. अरे सर मगर वो तो shares है तो क्या हो गया? Even though it is a share, you are virtually guaranteeing 200 rupees per share which is held. So the only equity shares which are exhibiting equity characteristics are the remaining 6,000 shares. So these 6,000 shares are exhibiting equity characteristics, but 4,000 are not exhibiting equity characteristics. So now if I am going to buy back these shares, okay, I have entered into this contract. If I'm going to buy back these shares, so entry will be I credit either bank or the liability. Okay, I credit either the bank or create a liability. The question is, आप debit किसको करोगे? See, you have the startup S Limited has entered into a contract to buy back its own shares from the investor at rupees 200 for 4,000 shares. So now we told you that there is no equity feature evidenced by these 4,000 shares. There is no equity feature. So now the question is, in your balance sheet, I have equity share capital. I have equity share capital 10,000. But sir, 10,000 तो मेरा equity है ही नहीं ना. 10,000 is not my equity at all. 10,000 में से 4,000 I have given a guaranteed return. 4,000 I have given a guaranteed return. Why guaranteed? Because I, the company, has told the investor that after 5 years, we will buy back 4,000 shares at rupees 200. Can you tell this to other equity shareholders? नहीं बोल सकते. You cannot tell this to other equity shareholders. You are guaranteeing the investor 200 rupees on 4,000 shares. That means what? It is not equity. नाम भले equity हो, whether the name is equity, we are not concerned. We are concerned with the feature of that instrument. That instrument, that is the contract for purchasing own equity instruments numbering 4,000 at 200, that contract is virtually not equity shares in issue as on date. Yes, and therefore, though my balance sheet has 10,000, 4,000 equity shares do not have a residual interest. They have what we call a guaranteed return. They have a guaranteed return. And then, therefore, the only equity instruments that are exhibiting equity features are the remaining 6,000. So as Janvi has rightly said, what am I going to debit? Sir, I am going to debit other equity. I'm going to debit other equity. Sir, why other equity? Why not equity share capital? You are saying 10,000, 4,000 do not exhibit, only 6,000 exhibit. So why other equity and why not equity capital? Because as of today, I am having entire 10,000 equity shares. See, I have to communicate the substance. Understand accounting first of all. Accounting cannot override the legal principles. But I have to ensure that the financial statements communicate the substance of the transaction. So how am I going to achieve that? What is the legal form? There are 10,000 equity shares. So can I say there are not 10,000 equity shares? No. And doing that will be against the law. So you have to say there are 10,000 equity shares, number one. Okay. But sir, out of 10,000, only 6,000 are exhibiting equity features. Agreed. That means you have to cancel out the remaining 4,000. Sir, can I debit equity capital right now? Not yet, because the buyback has not yet happened. But if you do not do anything and if you keep quiet, you are saying there are equity shares numbering 10,000 in INR value and they are exhibiting equity features, which is not right. So therefore, what you do is you will debit other equity. Other equity is going to have a debit balance in your total equity. Okay. Total equity means equity capital plus other equity that is there. So therefore, once you debit other equity, the net equity will automatically be stated at 6,000. After 5 years, when you do the buyback, what is the entry that you are going to pass? You will pass the entry equity share capital account debit to other equity. You will pass this entry after 5 years when the actual buyback happens. Because when the actual buyback happens, at that point of time, you will see that the shares are coming back to you and you are extinguishing them. Okay. So equity share capital will be 10,000. Other equity is going to be 4,000, and therefore the overall effect how it looks like is there are 6,000 equivalent amount which is representing equity characteristics. But will you see 6,000 separately? Answer is no. You will see equity capital 10,000 and other equity as 4,000. Is it okay? Did you understand? So therefore, if you are entering into a contract, for purchase of own instruments at a fixed number for a fixed price, that means what? This contract is passing the fixed for fixed test. So if you are entering into a derivative contract to purchase your own equity instruments with a fixed number for a fixed price, then that amounts to other equity. That amounts to equity. Is it okay? Yes. Is it okay? Sir, for this type of buyback also we are required to create the reserve. That will be done at the time of actual buyback. After 5 years, wo jab bhi hoga, that time you will have to create an actual reserve. Okay. Because till now the capital base in company's law terms has not eroded. Okay. In company law terms, equity capital continues to remain at 10,000 shares. So there is no erosion on the date you are entering into this contract with the investor. After 5 years, when the capital base erodes because of the buyback, at that time you will have to create a capital redemption reserve. Okay. So that will be done on the actual buyback that is there, not at the time of creating this other equity entry. Okay. So now this is done equity capital to other equity. Now any other case will be just a financial asset. Okay. That means variable number of shares for fixed price, or fixed number of shares for variable price, or variable for variable. All these three contracts where you have a right to receive your own equity instruments. In all these three cases, variable price, fixed number, fixed price, variable number, or variable number, variable price. All these three things, there is variability in any one or both, then it will go and be classified as a financial asset. It will be classified as a financial asset. Are we clear with the definition of financial asset now? Let us look. Okay. A contract that will or may be settled in entity's own equity instruments. That means what? S Limited khud ka share kharid raha hai. S Limited is buying its own shares and is a derivative. Is it a derivative in our example? Yes, you are entering into a contract after 5 to purchase your own equity instruments after 5 years. So it will be settled in the future. The value of that will probably depend on the movement of your price. And finally, there is no initial payment or investment that is going to be made. So therefore, a derivative that will or may be settled other than by exchange of fixed cash or other financial asset for fixed number of equity of entities' own equity instruments. So settled other than by fixed amount of cash for fixed number of entities' own equity instruments. So other than fixed for fixed will be a financial asset. That means fixed for fixed for own equity is going to be regarded as equity, Bolo, anybody has any doubts now in the definitions? Does anybody have any doubt in the definition? This part is also done. Okay, this part is also done. Yes. Anybody, any doubts? Good morning, Namrata. Good morning, Purnima. Good morning, Panu, Kaushiki. Good morning. Yes, come on, tell me. Anybody has any doubts now? 4,000 is not equity. See, understand. Please understand. Understand the transaction. Investor S Limited. Okay. Now see, please understand. I'm explaining once again. Okay. I am in the books of the investor. So when I make my investment, I will pass the entry investment in S Limited debit to bank. Okay, so this is the entry that will be passed. Now S Limited will pass the entry bank account debit to equity share capital to securities premium. So this is the entry that is going to be passed. Now this will be passed for how many shares? Sir, this will be passed for 4,000 shares of the investor plus 6,000 shares of the others. Okay. The others you have not entered into any contractual obligation like purchasing the shares at a fixed price. You have entered into an obligation with these 4,000 instruments. So now, by virtue of this agreement, what am I going to record? Immediately, I will record other equity debit to liability. Or if you are paying, I'm not paying in this example. So immediately I will record a liability. So can you see that basically I am moving it to a liability? I'm moving it to a financial liability because you have a contractual obligation to buy your own shares at a fixed amount for a fixed price. Yes, at a fixed number for a fixed price. So have I moved it to liabilities? Answer is yes. And if you've paid it off, it will go to the bank, but otherwise it will generally be credited to liabilities. Now the question is, what happens to these 4,000? Why should anything happen? I have given the treatment of these 4,000 shares now. I have given the treatment already. So if you look at your financial statements, the reader of financial statements will see two things. He will see equity capital 10,000 shares. He will ask for the members register to see whoever is there. He will notice that the investor is a member. So therefore, I should show equity capital as 10,000. But out of 10,000, 4,000 shares do not represent equity. Why? Because they represent a fixed return for something which is named as equity. So that is not equity, and that is why we debit other equity. We are not classifying the instrument as other equity. Don't mistake that. Okay. See, right now I am having equity share capital 10,000 shares credit. but out of 10,000 shares 4,000 तो equity है ही नहीं, so I will have to debit it. I'm not saying that 4,000 is other equity. I am saying that the remaining 6,000 is equity. I want to show this result in my financial statements, and that is why I have to debit this with other equity. Are you able to follow? Yes. Sure, Kaushiki. So I'm ultimately showing it as a liability only, as a liability. Or if I am paying it off, I will credit the bank. Okay. If I'm paying it off, I will credit the bank. Is it okay? So I hope you would have understood. At the time of getting subscriptions for shares, the company will segregate 4,000 as a liability and 6,000. Again, the answer to that is no. You cannot avoid Companies Act. In the Companies Act, so what you can say, under the Companies Act, you will say that I have issued 10,000 shares. So I will not segregate that 10,000. That 10,000 is legal obligation. You will come across n number of cases where you will have these kind of treatments. Okay. In fact, when you do your business combinations and in that you study reverse acquisitions, the acquirer is the acquiree and the acquiree is the acquirer. Okay, that means the legal acquirer is the accounting target and the legal target is the accounting acquirer. So how do we do the accounting? We do the accounting such that the substance is conveyed and at the same time you are also ensuring that the legal position is maintained. Okay, so the same thing we are going to do it here. I have to convey to the shareholders that 10,000 shares are there in subscription. So वो नहीं change हो सकता. But at the same time, you have to convey to the reader of financial statements that I have 10,000 agreed, but उसमें से 4,000 represents fixed return. 4,000 represents fixed return. So मेरे financials में भले ही 10,000 हो, it may be 10,000, but actual equity features कितने हैं? It is only 6,000. I have to show that my actual equity featured instruments are 6,000 in number, and therefore I cannot go to the balance sheet, delete 10,000 and make it 6,000. What I have to do is I have to create a debit and a corresponding financial liability equivalent to these 4,000 equity shares. I'm not classifying them as equity. I am separating them. So as to ensure that the remaining 6,000 are shown as equity. And that is why when it is a fixed for fixed contract, you are going to have it appearing as an item of equity. Why equity? It is ensuring that the remaining instruments are classified properly as equity. Are you able to follow now? Yes, sure. I am ultimately moving it to a liability or paying it off through the bank. So ultimately this is the entry which is done, but you are concerned with this. You are going to be concerned with this. This liability will be reversed after 5 years. If you have a contract for 5 years, then after 5 years, you will pay off that liability. So basically, after 5 years, you will have two entries which will be passed. After 5 years, you will have two entries that will be passed. First entry will be, if you are paying it off, you will pass entry liability account debit to bank. But other equity will be left. So you will pass the entry equity share capital when you actually buy back. The equity shares, you will buy back the equity shares 4,000 and you will be able to credit other equity. So now liability also gets settled after 5 years. And the other equity also is eliminated because now an actual buyback is going to happen. So this is how the financial statements will look like. Did you follow, Namrata? Yes. You are not able to link it with the fixed for fixed test. Okay, fine. Now, see. Okay. A contract that will be settled in entity's own equity instruments. So this is S Limited's own equity instruments. Number one. Okay. It is a derivative. Yes, because I have entered into a contract to buy my own equity instruments at a future date for a fixed price, for a fixed number, and therefore that is how you will be classifying it as a derivative. That is how we are classifying it as a derivative. Now the question is, see, don't get confused. I have a contract to buy back 4,000 shares, not today, after 5 years. That means what? Out of 10,000 shares, 4,000 shares are not exhibiting equity features. 4,000 shares are not exhibiting equity features. Why? I have entered into a fixed contract. I have entered into a contract, one second, for a fixed number of shares at fixed price. At fixed price. Okay. So in effect, what I'm giving is a guaranteed return. In effect, what I am giving is a guaranteed return. And because I am giving a guaranteed return, these 4,000 shares, now see, when I use this statement, these 4,000 shares, that means I am meaning the 4,000 shares which are there in equity share capital. Don't get confused between the terms which I am using. I am using 4,000 convertibly. One time I am saying 4,000 from the perspective of the legal position. That is, there are 4,000 equity shares. There are 4,000 equity shares. Okay. The legal form. The other form is 4,000 equity shares, financial instruments. So that is one form which I am using. So now please pay attention. Out of 10,000 shares, I have given a guarantee on 4,000 shares. I have given a guarantee on 4,000 shares. So do these 4,000 shares exhibit equity features? When I say equity features, I am talking from the perspective of the investor as well and from the perspective of the entity as well. Do these 4,000 shares exhibit equity features? Answer is no. Why no? Because they do not have a residual interest. They do not have a residual interest in the net assets of the startup. And because they do not have a residual interest in the assets of the startup, should I classify them as equity? Answer is no. You cannot classify them as equity. So in other words, your equity instruments in reality are 6,000 in number. Your equity instruments in reality are 6,000 in number. I'm not going into the rupee calculation. Okay. So the first day when you come out with a subscription, what is the entry you will pass? Sir, I will pass the entry bank account debit to equity share capital. Okay. Bank account debit to equity share capital to securities premium. How many shares did I issue? Sir, I issued 10,000 shares. At what price? Sir, I issued it at a price of 100. So 10,000 into 100, that means this comes to 10 lakhs. Please correct me if I'm wrong. This is 1 lakh and this is 9 lakhs. Okay. So the first entry that you are going to pass is This. Sir, this is which entry? Legal form. I have met the requirements of the Companies Act. So first part is done. Now we come to financial instruments. Sir, out of this equity shares of 1 lakh, 40,000 rupees, that means 4,000 shares, they do not exhibit equity features. Why? These equity shares actually exhibit liability features. Why a liability feature? Because I'm giving a guarantee. I'm giving a guarantee. So if I'm giving a guarantee, I have to show the reader, I have to present to the reader that I'm actually having an obligation against these instruments. I'm actually having an obligation. So when I have to present that, on the same date, you will pass the second entry. What is the second entry? You have entered into a contract to buy back after 5 years. Today I am not doing the buyback. आज के तारीख में buyback हो रहा है क्या? The buyback is not happening today. The buyback is happening later. So the entry that you will be passing is you will pay something in the future. So it will be to liability. To liability. And this is going to be for how many instruments? Those 4,000 instruments which you have promised you will be settling at 200, which you have promised that the settlement will happen at 200. So 4,000 into 200, this comes to 8 lakhs. You virtually have an obligation of 8 lakhs sitting on your head. Are you clear till now? Till now, is everybody clear? Yes? Any doubts so far? Any doubts? Anyone? Till now, is it clear? Okay. Now the whole problem that arises now is, what should I debit? What should I debit? Debit किसको करेंगे? Will I debit an asset? Will I debit an asset? That means, will I debit a financial asset? What am I getting? Look at the contract. I am going to get back my own equity shares. I am going to buy back my own equity shares. So if you look at the definition, okay, it is a contractual right to receive cash or another financial asset, or a contract that will be settled in own equity instruments and is a derivative. It meets the condition for a derivative. It is going to be settled. It is going to be settled. Now we look at the settlement. Against the 10,000 shares which I have issued, you tell me, from the first day itself, are 10,000 shares exhibiting equity features, or right from day one, only 6,000 shares are exhibiting equity features and 4,000 shares are exhibiting a guaranteed return? What do you think? Right from day one, is it 10,000 shares which exhibit equity features? Number one. Or right from day one, is it only 6,000 exhibiting equity and 4,000 are not exhibiting equity features because we give them a guaranteed return? What do you guys think? What do you guys think? What do you guys think? 4,000 are exhibiting a liability feature. Basically, they are getting a guaranteed return. Basically, they are getting a guaranteed return. And because they are getting a guaranteed return, can I debit financial asset? See, look at the balance sheet. If I have equity share capital and SEC premium of 10 lakhs. And I have financial asset of 8 lakhs. Do you think this makes sense to me? Do you think this makes sense to me? Answer is no, it doesn't. Why? Because I do not have the equity instruments exhibiting, I do not have 10,000 shares exhibiting equity features. Nahi hai mere paas. I have only 6,000 shares exhibiting equity. So therefore, I am constrained to say that this will be other equity for 8 lakhs. This will be other equity for 8 lakhs. Sir, capital debit kar do na. You debit equity share capital. Legal form bhi to yaad rakho. Am I buying back the shares today? Answer is no, you are not buying back the shares today. You are buying it back after how many years? You are buying it back after 5 years. So the actual buyback process will happen after 5 years. So how can I record it? You are a reader of financial statements. आप लोग balance sheet निकाल के देखोगे, there are 6,000 shares. As a reader, can you go to the bank and ask for the members register? Yes, you can ask members register. In the members register, on the first day, आपको 10,000 shares दिखेंगे. But if you go to the financial statements, you will notice that only 4,000 shares are there. If you do the buyback entry on the first day, then you will be puzzled. Your members register is showing 10,000, but financials are showing 6,000. Where did the remaining 4,000 shares go? 4,000 shares. You cannot show the buyback entry on the first day for that reason. You will be violating the legal requirements also. So therefore, what do is we park it under other equity. We park it under other equity. That means what? That means what? Now the question is, this is a contract for purchase of own instruments. This is a contract for purchase of own equity instruments for a fixed number of own equity instruments at a fixed price. So from my perspective, the issuer's perspective, S Limited's perspective, I am buying back, I have entered into a contract to buy back a fixed number of shares for a fixed price, and therefore it is getting classified as equity. It is getting classified as equity. And now you come to the definition. It is a derivative. Yes. That will or may be settled. Okay. Other than, that means other than by exchange of fixed amount of cash or another financial asset for a fixed number. We are looking at whose definition? We are looking at financial asset. A financial asset is a derivative that will be settled. When they say other than, that means can I say that it is a financial asset, it is a derivative that will be settled by variable number or price for or in entities own equity instruments. Can I say this? If the settlement is happening for a variable number of shares, for a variable price, if both are variable, then the instrument is not equity in nature. The instrument is not equity in nature means what? If the 4,000 shares are not fixed or the price on that is not fixed. If you are a company and you are in a negotiating position, you will tell the investor, You want me to buy back 4,000, I will buy back 4,000 from you, but I will not buy it back at 200. उस time पे जो भी price prevailing है, we will do a valuation after 5 years. After 5 years, whatever be the price that we get, whatever be the value that we will get, at that value, I'm going to buy back the shares from you. Now you tell me if this is the contract, then do you think that the investor is bearing equity risk? Answer is yes, because your value after 5 years can go sky high also, and it can go to a very low value also. That risk is on whose head now? That risk is entirely on the head of the investor. And if that risk is on the head of the investor, how many equity instruments are exhibiting equity features? That point of time you will say that, sir, all the equity shares in issue are exhibiting equity features. So do you have to cancel out anything? Answer is no. So that point of time, you will not say this as other equity. You will call it as a financial asset. Why will you call it as a financial asset? Because the settlement will happen for a variable price in respect of a fixed number of equity instruments. So that is how you will do it. Okay. So this is how you are going to evaluate. Okay. So right now, coming back to our question, coming back to our discussions. Okay. Coming back, let me complete this one thing for you. Okay. Did everyone understand why it is other equity? Yes, no doubts till now. No doubts. Yes, in that case where the price is variable or number is variable, it won't affect equity. Okay, it won't affect. So till now, it's all clear. Coming to the next entry on the settlement date. After 5 years, the settlement hoga. When the settlement happens after 5 years, you will have the entry liability account debit to bank. By contract ke hisab se, you will have to pay it off. I paid it off. So therefore, liability ka kissa khatam. It is settled after 5 years. The question is other equity. Or after 5 years, what are you going to get? You are going to get your own equity instruments. Buyback ho raha hai na? So if you are buying back, the equity shares of that person is going to come back to you. So we will have to book that buyback. So how am I going to book that buyback? Simple. You will pass the entry equity share capital debit. How many shares are coming back? Sir, 4,000. Each share ka value kitna hai? 10 rupees. So 40,000. That means the buyback premium is how much? Generally, it goes to securities premium, assuming you have adequate balances. So securities premium account debit. How many are there? Well, 4,000 into how much? 90 or 190? Answer is 190 because you promised a buyback at 200. So 200 minus 10 is the face value. 190 you will be paying extra. So 190 into 200, that comes to 7,60,000. And credit what? I will be crediting other equity. So now understand. Abhi zara please understand. Okay. Just understand this. Day 1. Okay. Or I call it as year 0. Your equity. What was represented? Sir, it is 10 lakhs minus. I had debited other equity. So therefore, minus 8 lakhs. So this is 2 lakhs. Okay. Now, year 5. when the settlement happens. Year 5, when the settlement happens. How does it actually look like? Equity share capital, sir, 1 lakh minus 40,000. So this comes to 60,000. Securities premium. Securities premium. How is it going to look like? 9 lakhs minus 7 lakh 60. So that comes to how much? 1 lakh 40,000. So the total kitna aata hai? 2 lakhs. Is there any change in the position from year 0 to year 5? There is no change in the position. I had to show that my equity is worth 2 lakh rupees in the business. It is worth 2 lakhs. Okay. And that is what I have shown it. That is what I have shown it. Of course, in the 5 years, there will be profits, there will be retained earnings, which will grow, etc., etc., etc. So they will also come. But right now, this presentation is only, forget the profitability. I am able to achieve a sound presentation right from year 0 by virtue of this particular financial instruments definition. Which is the substance? See, substance means what? After 5 years, your equity components will be at 2 lakhs. And it is not a fact that came to light after 5 years. It was something you already knew on the first day of the year when you issued the equity. It was something you already knew. So if you already know something, you should present that right from year 0. You should present that right from year 0. Only then it makes sense. Okay. So therefore, I am achieving a substance presentation in year 0 as well, without mitigating or violating the Companies Act provisions. Have you guys understood entirely the structure, substance of the transaction? Yes. Entries, everything is clear? Yes. Sure. Please confirm. Shriram, Purnima, Namrata, Kaushiki, Janvi, Panu, Viraj. All clear? 200%. 200% clear? Yes. Okay, fine. Okay. Anybody has anything to add here? Any more doubts? Okay, good. Everybody has confirmed. Fine. So, when you are entering into a derivative contract with a fixed for fixed clause of purchase of own equity instruments, then it will be classified as own equity. I mean, it will be classified as equity. It will not be classified as a financial asset. If it is other than fixed for fixed, which is how the definition is worded, then it will be regarded as a financial asset. It will be regarded as a financial asset. Okay, so now coming back to our definition, we have completed the definition of financial assets. We have completed the definition of financial assets. Is it okay? Yes. So all the definitions are cleared. All the definitions are cleared. Anybody who has not understood the definitions? Equity we saw, loans, liabilities, everything we saw. Yes, and equity also we have visited. Good. So that takes care of the definitions that we discussed. That takes care of the definitions that we discussed. Okay. I had asked you to go through the what you can say, some of the illustrations. Could you go through the illustrations? Anybody has any doubts? Anybody has not gone through? Izzat se bolo, did you guys go through the illustrations which I told you to check? Okay. No, nobody answered. Yes. Did you go through the illustrations? I had requested you in the last class to go through the illustrations. Did you go through the illustrations? कोई आंसर नहीं कर रहा है. अरे बोल सकते हो नहीं देखा सर हमने. You can tell me that you have not visited. That is also fine with me. Okay. Okay, fine, fine, fine. All right. Okay, 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 okay. Not visited. कोई बात नहीं. Don't worry. If you have not visited, nothing serious. Okay. Nothing serious. I want you guys only to do these illustrations. I am okay. Fine. ठीक है चलो. Quickly we shall just process the illustrations. Okay. कर देते हैं. It won't take more than 15-20 minutes. Okay. We'll only do it. Don't worry. Okay. All right. These illustrations won't come in your exam, but it is to make you understand what is equity, because what happens is, unless you identify the nature of the instrument, whether it is an asset, a liability, or equity, accounting becomes difficult. Okay. If you go wrong in the identification, accounting, you'll make a mistake and you'll lose up everything. Okay. You just made the examiner's job easier by giving the wrong answer in the very first step. उसके बाद वो दूसरा पढ़ेगा ही नहीं. He'll not even read that, because he will believe that first step only is wrong. Why should I even go to the next one? And he is right also in doing so. So in that sense, these illustrations are important. Okay, so let us quickly just brush through them. A Limited makes a sale of goods to customers on credit. So sale of goods on credit of 45 days. Okay. The customers are entitled to earn a cash discount at 2%. That is also fine. If payment is made before 45 days, and interest at 10% per annum is charged for payments made after 45 days. So evaluate whether such trade receivables are financial assets or not. What do you guys think? Is the trade receivable a financial asset? Is the trade receivable a financial asset? No problem. I'll take care of the illustrations right now. No worries. Okay. All right. What do you think? Illustration 1. Is it a financial asset? Come on, guys. Simple sa question. Don't look at the answer. The least you can do is avoid looking at the solution. Look at the definition of financial assets. It is a contractual right to receive cash. Is this a contractual right to receive cash? Yes. Acha, is there a need to have a contract written? Answer is no. Your invoice which is there, the invoice is basically a contract document. Arey bhai, what is the invoice? Basically, the terms which you have agreed are put on the invoice. You sign it, the party accepts it. So there is a contract. The invoice that is there is a binding contract on the invoice issuer and invoice acceptor also. So from the seller, the buyer, the invoice is a document that links everything. For every purchase, you need not have a contract on a stamp paper executed. So therefore, invoice meets that term. As per that terms, you are having a 45 days credit. So the contractual obligation exists to receive cash. Discount upar niche, it would be a trade practice, but this gives you a contractual right to receive cash. And therefore, are they financial assets? Answer is yes, they are financial assets. Okay. So they are. So yes, financial assets. Okay. Very simple questions. कोई फर्क नहीं पड़ता. Okay. Z Limited makes sale of goods to customers on credit. Okay. Goods are carried in large containers for delivery. Okay. All the dealers are required to deposit a fixed amount of 10,000 as security for the containers. Container समझ में आता है अपने को. You go to this shipping yards and all. You have this company which is into the container business. Maersk, you would have seen these containers. बड़े बड़े container होते हैं which go on ships, trains. Normally railway lining goes into the stations, goes into this Maersk yards, so that you just dump the goods into the containers and Maersk will take care for transporting. So Maersk does not sell the containers. Maersk gives you a right to use that container for the purpose of transporting your goods. And for the purpose of that, you are typically required to give a security deposit. Okay. So all the dealers are required to deposit a fixed amount of 10,000, which is returned only when the contract terminates. Okay. So I have given a deposit. I have a right to receive that deposit back after the contract is terminated. The deposits carry 8% per annum interest, which is payable once the contract terminates. If the containers are returned by the dealers in a broken condition or damage caused, then adjustments will be made. So how would you treat such deposits in the books of the dealers? Look at the question. Look at the question. You tell me whether it is meeting the definition of a financial asset or not. Is it giving a right to receive cash, a contractual right to receive cash? Do you have a right to receive your cash back? Yes, there is. आप deposit दोगे, the contract is saying you will get the money back. So you have a contractual right to receive cash, and that is why, how would you treat them? Well, you will end up treating them as financial assets. You will end treating them as financial assets. Okay. Returned. This takes care of the definition. Returned only when the contract terminates. Fair enough. Fair enough. Okay, but the important fact is cash is coming back, and therefore it will be a financial asset. Okay, fine. So that takes care of illustration 2. Examples we have done, so I don't have to do that. Okay, all right. Now, coming to bonds. A issues a bond at principal amount of 1,000 per bond. Okay, principal is 1,000 per bond. The terms of the bond require annual payments in perpetuity at stated interest rate of 8% applied to the principal amount of 1,000. Assuming 8% to be the market rate of interest for the instrument, the issuer assumes a contractual obligation to make a stream of future interest payments having a fair value of 1,000 on initial recognition. Okay. All right. That's right, Sriram. That's right. Okay. So evaluate the financial instrument in the hands of both the holder and the issuer. Okay. Holder, issuer. Issuer has issued debentures. What are the terms? Payment in perpetuity. Perpetuity समझते हम लोग? Do you understand perpetuity? This bond will never be redeemed. This bond will never be redeemed. And if it is never going to be redeemed, Can you say you don't have any obligation? No, you have an obligation. You have obligation to make interest payments. And because you have obligation to make interest payments, the stream of interest payments represents a financial liability for the issuer, and that stream of interest payments represents a financial asset for the holder. So that is how you are going to have. There is a contractual obligation to deliver a stream of cash flows. Okay. Not the principal, but a stream of cash flows. So it meets the definition of a financial liability for the issuer and a financial asset for the holder. Okay. All right. Creditors for sale of goods. Same, we have already done it. I'm not going to discuss. Contract for exchange on unfavorable conditions. You read this. This one you can do it for homework. Basically, you did not settle the liability. Then you approached for rescheduling, and the rescheduling changed your installments, changed the amount per installment. Is it still a financial liability? Answer is yes. Okay. Answer is still yes. Okay. So that is the question. You can go through that. Okay. So this I had told you, when a company proposes the dividend, no obligation arises. When the dividend is approved in the AGM, the company has an obligation to distribute, and therefore it meets the contractual obligation requirement, and therefore it becomes a financial liability. So this I had told you. Okay. Next one, you are having preference shares with non-cumulative dividend. I told you this also. Irredeemable preference for this will be regarded as equity. This will be regarded as equity. Have you understood illustration 6? We had discussed it, if I remember correctly. Are you able to recollect illustration 6? Irredeemable preference shares. We had discussed it, I think. Yeah, I had discussed it. Debentures, preference shares, discretionary, irredeemable, compound financial instruments. Yes. Okay, so that is clear. Next one, illustration 7. Non-derivative contract to be settled in own equity instruments. Okay, fine. Now please pay attention. This starts to get interesting. A invests in compulsorily convertible preference shares. Compulsory. Optional hai kya? No, it's not optional. It's mandatorily convertible. Preference shares issued by its subsidiary B Limited at rupees 1000 each. Under the terms of the instrument, each compulsorily convertible preference share is compulsorily convertible into one equity share of B at the end of 5 years. Such CCPS carry dividend at 12% per annum, payable only when declared at the discretion of B Limited. Evaluate this under the definition of financial instrument. I want you to think and tell me the answer with reasoning. Please think from both the perspectives, the principal as well as the stream of cash flows. Please think from both these perspectives, principal as well as the stream of cash flows. Think. I'll just be back in a minute. Okay. Okay. So I have an answer. Yes. All right. Okay. Okay. I have compulsorily convertible preference shares. Okay. So this is illustration 7. This is illustration 7. Okay. Now let us look at the stream first and then we'll try to understand. Okay. A Limited invests in CCPS issued by its subsidiary B Limited at 1,000 each. So A Limited, B Limited. B Limited issues compulsorily convertible preference shares of rupees 1,000 each. Okay. All right. And then under the terms of the instrument, each CCPS compulsorily convertible into one equity share. So conversion ratio 1:1. Okay. Under the terms of the instrument, each CCPS compulsorily convertible at the end of 5 years and it carries 12% dividend. 12% dividend payable at the discretion of B Limited. Payable at the discretion of B Limited. So dividend, discretion of B Limited. Okay. So now you will have to check whether it is a financial liability for B or equity, and let us look at that from that perspective. Okay. So now the conversion option, it is being converted in the ratio of 1:1. So one share of B Limited, one compulsorily convertible preference share of B Limited will be converted into one equity share, and you have procured them at rupees 1,000 each. So fixed price, fixed number. So is it meeting the fixed for fixed test? Answer is yes. Fixed for fixed test is met. And if the fixed for fixed test is met, then it will be regarded as what? Then it will be regarded as equity. Then it will be regarded as equity. You meet the fixed for fixed test when the settlement is in own equity instruments, it will be regarded as equity. And then the second case is, the second stream is dividends. Is it mandatory or discretionary? Answer is, sir, it is discretionary. And because it is discretionary, it will be regarded as equity. It will be regarded as equity. So therefore, is this whole instrument purely equity, purely financial liability, or compound financial instrument? Answer is, it is purely a financial liability. It is purely a financial liability. Is it okay? Yes. So that takes care of illustration 7. Illustration 8. Illustration 8. Let us go through. Okay. Target Limited took a borrowing. Target Limited, yes, that's right. So the declaration is at the discretionary. So therefore, it is going to be an equity instrument. It is going to be an equity instrument. Okay. All right. Target Limited took a borrowing. Illustration 8 took a borrowing for 10 lakhs. Z enters into an arrangement with Target. Z enters into an arrangement with Target for settlement of loan against issue of a certain number of equity shares of Target, whose value equals 10 lakhs. For this purposes, fair value per share shall be determined based on the market price of the shares of Target Limited at a future date upon settlement of the contract. Evaluate this under the definition of financial instrument. Okay, so now I want you to tell me Read the question. Tell me whether it is a financial liability or an equity. Read the question and tell me whether it is a financial liability or equity. Kaushiki is right. Yes, Namrata, tell me. Others, Viraj, Shriram, Nikita, Panu, Janvi. Today Janvi is quiet. Okay, just for my this thing curiosity, from where are you guys actually? Because okay, where are you guys from? Janvi, Namrata. I see WROs, NROs, SROs. ERO is also there. CRO is also there. Okay. Okay. All right. Fine. Let us understand the transaction. Okay. Illustration 8. Okay. Illustration 8. Okay. So now, Target Limited took a loan. Target Limited, Z Limited. So Target Limited had taken a loan worth rupees 10 lakhs. Okay. And जब repayment की बात आ रही है, it is going to repay by way of issue of equity instruments. By way of equity instruments. Okay. Now the question is, how am I going to treat it? Okay. So the question is saying it will be regarded as settlement for a certain number of equity shares whose value equals 10 lakhs, fair value based on market price at a future date. Okay. So equity instruments, X number for Y price. Do I know Y price? I do not know Y price. What is the Y price? It will be the future market value. वो आज मेरे को मालूम नहीं. If the price is not known, the number also will not be known. See, ultimately, X into Y should be equal to 10 lakhs. Agreed, X is the number, Y is the price. ना मेरे को X मालूम है, ना मेरे को Y मालूम है. All I know is the total should be equal to 10 lakhs. X into Y. Okay. So now, if I knew even one component, X or Y, दोनों के बीच में if I knew even one, I could call it as fixed for fixed because there is no other way you could get the other component except for dividing by from 10 lakhs. Okay. So if I knew X, Y would also be fixed. If I knew Y, X would also be fixed. But here I don't know both. And because I do not know both, it is meeting which requirement? It is meeting a fixed for fixed requirement. We had done this before. Now please try to recollect. Z Limited has given 10 lakhs and Z Limited says, I want your equity shares. Okay. Z Limited wants the equity shares and Z Limited says, I will take that much of equity shares as is equal to the fair value at the time of settlement. So basically, who is having the risk? Is Z Limited having any risk? Answer is no. He is taking a full and complete equivalent amount in the form of equity shares at the time of settlement. So therefore, what is this transaction? For Target Limited, does Z Limited become an equity holder? Answer is no. He continues to be a liability. Why? Because he is changing his holding depending on changes in the price. So I am ultimately having to settle him for rupees 10 lakhs only. It's just that the numbers are going to fluctuate in the future, and therefore risk of the payment remains with Target Limited. Although it happens in equity, the risk remains with Target Limited. What is being settled is exactly 10 lakh rupees, and therefore for Target Limited, the contract continues to be a financial liability. The contract remains a financial liability. Okay, so that is how it will be. Okay, so I hope you guys understood that. Yes, Target Limited has the risk. Okay, so Janvi from Ghaziabad, Panu from Orissa, Kolhapur. Okay, all right, good, great. So I have quite a number of Chennai. Myself, I am actually from, I am right now taking your sessions from Goa, where I'm based. Okay, so myself in Goa, I'm actually from Karnataka, but I work here. Okay, so yeah. All right, so that takes care of illustration 8. I hope everybody understood illustration 8. Let us move on to illustration. Any other illustration is there? Nope. All illustrations are done here. One or two instruments are there from the other units. Okay, just let me check. Yes, I had marked it and kept. Okay, yes. This is from the third unit, but because you know the definition of financial asset, liability, and equity, you will be in a position to answer this. A Limited issues preference shares to B Limited, that is the holder. Those preference shares are redeemable at the end of 10 years. Redeemable means it will be paid in cash. Entitle the holder to a cumulative dividend of 15%. Cumulative means what? If you don't pay now, next year you have to pay 2 years. If you don't pay 2 years, in the third year you have to pay for 3 years. In the fifth year, pay for the entire 5 years, etc. Basically, dividend goes on accumulating. Dividend goes on accumulating. The rate of dividend is commensurate with the risk credit profile of the issuer. Examine the nature of the financial instrument. Does the principal represent an obligation to deliver cash? Answer is yes. Does the stream of cash flows represent an obligation to deliver cash? Answer is yes. So this instrument becomes a pure financial liability. It's not even compound. It's a complete financial liability. Okay. So that is illustration 1 for you. Okay. So I think basic ones are done, but there is one more. Yes, did you understand illustration 1? Yes, okay. So we then move on to illustration 33. That is on the same chapter 12.115. See, we are moving back and forth, but that is because you know the topic. Okay, it's not like I will not do the remaining questions. Okay, it's just that you know the topics and I have the details which with me where I can see what question can be done when. So that is why I prefer to do it like that. Okay. So now coming to the next part, instrument convertible only at the option of the issuer. Okay. So now I will have to explain to you. This is debentures, preference shares issued. Okay. Debentures / preference shares issued. So now, okay, so now here, if you remember, we had studied distribution, we had studied redemption, and now we come to conversion. Now we come to conversion. अरे do you guys remember this? सर डिस्ट्रीब्यूशन में हमने क्या पढ़ा था, हमको याद नहीं है. हमको याद है, ओके, मैंडेटरी and this is discretionary. Discretionary. So mandatory is what? It is obligatory upon you to pay the interest or preference dividends. So in that case, this stream is going to be a financial liability. If it is discretionary, it is optional, then it is not going to be financial liability. It will end up being equity. It will end up being equity. What is important is discretion. Okay, it is all about discretion. Okay, when you talk about redemption, redeemable, irredeemable. If it is redeemable, you have to pay the money, so it will become a financial liability. Irredeemable means no obligation to deliver, cash, so therefore it will be classified as equity. And now we come to conversion. And this is obviously assuming fixed for fixed conversion. Variable hota, it would go and sit as a part of your financial liability, but assuming fixed for fixed, conversion could be option of the holder, option of the issuer. It could be at the option of the holder, or it could be at the option of the issuer. I want you to tell me, if the conversion option is at the option of the holder, what do you think it should be? Yes. Go ahead, take a break, no issue. I'll also take a break in a short while, because we'll just complete a couple of these questions and then we'll take a break. Okay. I will just complete a couple of questions on whether it is an asset or a liability or equity, and then we'll take a break, and thereafter we'll move on to classification. Okay, fine. So now, if it is convertible at the option of the holder, if it is convertible at the option of the issuer, what do you think? Is it a financial liability or not? You remember, you guys were there when I taught Ind AS 102, am I right? You don't have to understand that, Namrata. Okay. Okay. Forget that. Do you guys remember Ind AS 102? Do you guys remember Ind AS 102? Yes. Okay. I taught you Ind AS 102. There was one instrument, if you recollect. अगर आपको याद हो तो होना चाहिए. मुझे होगा because I have taught it like with over the last 2-3 times batches I have taught it. So if you remember, there was an option which was equity settled options with cash alternative. अरे अपने को याद है ये? Do you remember equity settled options with cash alternative? Means it was essentially a share appreciation right, but if there was no share up, if you did not want the shares appreciations, you could get the shares themselves. Okay, you need not have, I mean, if you wanted basically the option of the employee, if he wants, he can go for getting the shares, or if he wants, he can go for getting the cash. Okay, so the option was with the employee could choose. So basically, when we taught you at that point of time, what we mentioned was it is essentially a stock appreciation right, or you call it as equity settled options with cash alternative, or cash settled options with equity alternative. So essentially it is a financial liability with an equity option embedded, with an equity option embedded. This was how we did it. If you remember, we multiplied the total number of shares under the equity component by the value, and then the SAR with the value. The difference would go as the equity component, and the liability component would be recognized separately. If the entity, if the person opts for the financial, if opts for cash, you pay off the cash by debiting the liability, and here whatever balance was there in the reserve, we would transfer it to retained earnings. So this was what was done. If it was paid in equity, if the holder opted for equity, then at that point of time, what would you have done? Well, you would have taken the liability foregone as a consideration for the equity, transfer it to premium as well as equity share capital. This was what we used to do. The same thing is going to happen here. Basically, the option is with the holder of the options. Okay. So therefore, we will have to now check whether this is a financial liability or an asset. Obviously, this is a financial liability. Why financial liability? अरे कल को वो उठ के मेरे से पूछ भी सकता है ना, जा मेरे को कैश दे दे, I don't want your equity capital. So how can you say that it is going to be a financial how can you say it is going to be equity? It will not necessarily be equity. कल को उठ के वो he will ask he will ask the equity shares, then what are you going to do? Or he may ask for cash, what are you going to do? So essentially, this is also a financial liability with an embedded derivative, Okay. So this is the nature. Okay. So is the intention of the issuer going to matter here? Answer is no. It is based on the option of the holder. So holder's intention is everything. If holder says that it is going to be, if the holder of the instrument says he wants cash, you have to pay cash. If he wants equity, you have to pay equity. Okay. Coming to the next category, option of the issuer. Okay. If this is the case, I issued the instrument and I can only decide whether it is going to go into, I have only issued the instrument and I only can decide whether I will redeem the liability or whether I will issue equity. So if that is the case, What you need to know is it depends on the intention of the issuer. Depends on intention of the issuer. Depends on intention of the issuer. If he decides to he will be issuing shares, then it will be equity. If he says he will pay, then it will be a liability. Okay. So is it done? Yes. Did you understand this? So now coming to that question, these are optionally convertible debenture. Issuer has option to convert the instrument into a fixed number of own shares or to redeem the instruments in cash at any time. The redemption price is the fair value of the fixed number of shares into which the instrument would have converted it if it had been converted. Holder has no conversion or redemption options. Debentures have a tenure of 12 years. If not converted or redeemed earlier, will be repaid in cash at maturity, including accrued interests, if any. Examine the nature of the financial instrument. Okay, so now tell me quickly, what do you guys think? Yes, what do you guys think? Come on, come on. I need you to work it out. What do you guys think? Has the question given what the company intends to do? Has the question given what the company intends to do? Answer is no. So what are you going to be regarding it as? You will be regarding it as the principal component along with an equity option. Okay. So that is how you will be treating it. Okay. That is how you will be treating it. Okay. It will be settled. It will be settled with the equity option. So therefore, I mean, you have an option for settling in cash as well as in equity, and therefore it will be a compound financial instrument. The holder has no conversion or redemption options. Okay, so just for your understanding, nothing major or important in that. Okay, you will look at the intention. If intention is not given, you will make the assumptions and do it. Okay, all right, fine. So now coming to the next part. There was one question, yes, on derivatives. This question is important. You guys want to continue or need a break? Okay, so coming to that question, the distribution is a financial liability. So interest portion is a liability in our question that we did earlier. And And as far as the principal portion is considered, it is redeemable at the option of the issuer. So if it is redeemable at the option of the issuer, you can treat it as financial liability with an equity component. Okay, with an equity component. That is right. So you will take the earlier question as interest portion being a liability and principal as equity. Okay, with an option. All right, next. Okay, done. Illustration 14 is all about derivatives, which I have discussed. So the scope is determine if the contracts are derivatives or they are executory contracts. Executory contracts means already executed. Nobody has any obligation that is pending. Okay. So Company Z is engaged in the business of importing oil seeds to further process as well as for trading purposes. It enters into the following types of contracts as of 30th, as at 1st October 20x1. So what are you given is import of oil seeds from a foreign supplier. Quantity 100 metric tons at USD per metric ton to be delivered on 31st March 2022. Okay. Net settlement clause included in the contract. Yes, you can do a net settlement. Net settlement in practice, there have also been several instances of the oil seeds being sold shortly to or shortly after taking delivery. These instances of net settlement constitute approximately 30% of the value of the contract. Gross settlement means what? What do you understand by net settlement? What do you understand by net settlement? Okay. What we'll do, yes, no actual delivery. That is right. Okay. No actual delivery. That's right. Okay. What we'll do is, just give me some time in the middle of, we take a 10-minute break. We take a 10-minute break and then we shall resume. Okay. We just take a 10-minute break. There is somebody at the door. Okay. So just take a 10-minute break now and then we shall resume thereafter. Okay. All right. So, welcome back. So coming to illustration 4, there is a contract that requires importing of oil seeds from a foreign supplier. Quantity is given, rate is given with a future delivery. Okay, so we are on 1st October 21. The settlement is on 31st March 20x2. So it is a future delivery. At a price determined today, 100 metric tons at 400 per metric ton. So basically, if I look at contract 1 features, this is illustration 14. If I look at the features of contract 1, it looks something like this. Okay. One second. Contract 1, contract 2, contract 3. Okay, so I have these 3 contracts with me. And now let us evaluate each one based on the information that we are having. Okay, let us evaluate based on the information that we are having. Enters into the following type of contract: 1st January and 15th January. Okay, so settlement. First one is 31st March X2. Next one is 31st January X2. And the last one you have 15th January X2. Okay, so now the question is this going to meet the requirement of derivative is what we need to understand. So this is a contract entered into for purchase of a fixed quantity. Is it fixed quantity? Yes. At a fixed price? Yes. 30,000 per metric tons. So can I say a net settlement clause included in the contract? Answer is yes. If net settlement is included, fair enough. So net settlement. Yes. 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 Okay. Is gross settlement also possible? That is what we will have to check. And this I will check it contract wise. We will proceed. You have entered into a contract with a foreign supplier, 100 metric tons at USD $400. There have been instances of the oil seeds being sold prior to or shortly after taking delivery. That means, is gross settlement possible? Answer is yes. So gross settlement is also possible. Net settlement is also possible. Okay. So now the question is, you are required to determine if the contracts for purchase are derivatives or whether they are executory contracts. Okay. So now let us understand contract 1. We have a contract where we enter into a contract today for delivery at a future date with a net settlement option available. Gross settlement happens, and there are instances where 30% of the cases these contracts have been executed by net settlement. There are cases where 30% it has been executed by way of net settlement. So now I want you to tell me whether this is going to be a executory contract. Executory means what? Own use exemptions. I buy the goods and I consume them. Or whether it is going to be a derivative contract, because settlement happens in the future, net settlement cases are there. So in this scenario, contract 1, what do you think? Is it going to be a derivative contract or will it be an own use contract? Okay, will it be own use or an executory contract? Delivery happens on 31st March. So the terms are to be executed. So what do you guys think? Is it going to be a net settlement contract? Is it going to be a derivative or an executory contract is the question. What do you think? Are you there? Everyone? Okay. So, exactly. So different students have given different answers, and I won't say that your answers are incorrect. So like for instance, Kaushiki has said we can take it as executory because 70% of the instances there are cases where execution has happened. How 70%? Because the contract practice has established that 30% of the time there are instances of 30% of the value of the contracts we are having net settlement that is happening. So what happens is percent also could be significant, for some even 10% may be significant. Okay, that threshold is not defined anywhere. So if you go by the definition of significance, you will not find a rule. So typically for student life, you can take like 10% could be a significant threshold. So if anything goes above 10%, it ends up meeting the criteria of a significant amount. So in the case of contract 1, do I say that a significant number of contracts have been net settled? Answer is yes. Do I say that a significant number of contracts is net settled? Answer is yes. And if the contracts are net settled significantly, can I say that this contract should be treated as an executory contract or a derivative contract? Answer is it should be regarded as a derivative contract. So the institute has said it is derivative, which 2-3 of you gave the answer. Janvi gave the answer. Namrata gave the answer. But again, I reiterate, alternative answer is permitted. Alternative answer is possible. This is not given in the study mat. No problem. Okay, it is a question of judgment. The main issue is whether you are able to identify whether it is a derivative contract or not. So is it a derivative contract? Answer is yes, based on the premise of what? That 30% is a significant value for the purpose of arriving at a judgment as to whether it is executory or a derivative. And since a significant number is net settling, that means it is a derivative. So therefore, the entire contract is regarded as a derivative. That is the first answer which the institute has also given. And we acknowledge the accuracy of that answer. But what we want to say is an alternative solution is possible, where you can say that, sir, majority of the transactions are gross settled, no? So therefore, we'll take the whole contract as a gross settled one. And that is why we could have a tug of war between the two answers. But anyways, this is the solution. Okay, so that is fine. All right, next one. Purchase of oil seeds from a domestic producer or supplier. So net settlement practices. Company has net settled some of the domestic purchase contracts. Okay, net settled some. How much? Only 1% of the total purchase contracts in the value have been net settled. The remaining contracts are settled by taking delivery of oil seeds which are used for further processing. So contract 2, I want you to tell me, what is it? Is it executory or is it? Yes. Namrata, that is right. Okay. Is there any problem with the video? Am I okay now? Kaushiki, please confirm. Nobody complained. I also saw just now. Okay. Let me know if the video is fine. Okay. So contract 2. Most of the cases I have taken the delivery and I am using it for further processing. So can I say that I am using it for own use? Can I say that I am taking the delivery of contract for own use? Yes. If you are taking it for own use, that means will you be covered under the own use exception? Answer is yes. But do I record the entry today? Answer is no, because you will be recording it at a future date when you actually get the delivery of oil seeds at your premises. So after that only you will record. After that only you will record. Until then you will be taking it as an executory contract. Until then you will be taking it as executory. Once you get the delivery of oil seeds, you will pass the entry for purchase of oil seeds. So in this case, what will be the nature of contract? Gross settlement is also possible. Gross settlement is also possible. And now the conclusion of the contract is it is executory. Executory. Net settlement happens, but it is only 1%, which is definitely insignificant. So here there is no question of alternative answer. Okay, यहाँ पे होगा तो it is going to be an executory contract. अच्छा, executory contract means out of scope of financial instruments. Derivative contract, executory contract means it won't be covered under financial instruments. If it is inventory for you, for this person it will be covered under Ind AS 2. जब purchase होएगा, you will be recording it at the cost price. Cost includes freight, all expenses necessary to bring the inventory to present condition and location. All that will follow. Okay, so it will move out of the scope of Ind AS 109. Okay, and then the last part. Did everyone understand the first two cases, the first two contracts? Any doubts? Did everyone understand the first two contracts? Yes. All right. Now coming on to the next one. Now coming to the last one, that is contract 3. You have entered into a contract to sell oil seeds. You have entered into a contract to sell oil seeds on the commodity exchange, maturing as on 15th January 20X2. So where are you selling? You are entering into a contract to sell it on the commodity exchange. Okay, what is a commodity exchange? Something like a Bombay Stock Exchange or something like MCDX, whatever you are having, commodity exchanges. Okay, so now if you look at the commodity exchange contracts, the commodity exchanges are basically markets where gross settlement does not happen. Okay, you go to you enter into wheat futures, for example. You enter into wheat futures on the commodity exchange, or you enter into oil seeds futures. You will not get oil seeds. Commodity exchange is not a market jahan pe wo oil seeds tons together, they will keep it available for sale. It is an exchange for trading in or speculating in the price of the commodities. Speculating in the prices of commodities. Mandatorily, what will happen is net settlement is going to happen. Net settlement mandatorily happens on the exchange, on commodity exchanges. Okay, stock exchange is different again. Stock exchange mein there is actual delivery of equity shares, bonds. Okay, so therefore stock exchanges is not the same as commodity exchanges. Commodity exchange, you will not have physical delivery of the commodities, whereas stock exchanges you have physical delivery of equity, bonds, etc. So commodity derivative contracts or commodity exchanges will always have only a net settlement option possible, okay, which is given here. These contracts are required to be net settled. Required to be net settled means what? Net settlement is the only option. So net settlement is possible. Gross settlement is not possible. Gross settlement is not possible. So do I even need to look at the remaining words in the contract? No, but nevertheless we'll just have a look. Z enters into these type of derivative contracts to hedge the risks on the domestic oil seeds purchase contracts. So they have also said in the question it's a derivative contract, and we also have no reason to avoid treating it as such. It is a derivative contract within the scope of Ind AS 109. Within the scope of Ind AS 109. Have you understood? Did you guys understand? Yes. All clear? All the three contracts are clear. I hope you have these illustrations within the study module that you are having. Okay. Because I'm just picking the questions from the study mat itself. I'm not picking any other questions. Okay. So all the questions are clear. Let us then move on to the next part. So this part is done. This illustration is done. Next. It will appear that I'm altering between a lot of questions, but please don't worry. I am doing something which you will be able to understand. Okay. All right. Okay. Let us look at illustration 6. Okay. Silver Limited has purchased 100 ounces of gold on 10th March 20x1. The transaction provides for a price payable which is equal to market value of 100 ounces of gold on 10th April x1 shall be settled by issue of such number of equity shares as is required to settle the aforementioned transaction price at 10 per share on 10th April 20x1. Whether this is classified as a liability or equity is what you have to answer. Own use exemption does not apply. Own use exemption does not apply. Okay. So now I need you to tell me. Okay. We should not say purchased. The question is not correct to that extent. Has agreed to purchase. This should be the question, because if Silver Limited has purchased, then there is no doubt only. Okay. It is a contract which is already executed. Okay. So you will have to pass the entry. It will be a liability. Okay. But now Silver Limited has agreed to purchase 100 ounces of gold. The transaction provides for a price which is payable equal to the market value 1 month later. Settlement will happen in equity shares. So the question is whether this transaction is classified as liability or equity. Okay. So illustration 6. Silver Limited, seller. Seller is giving gold. In return, Silver Limited is giving equity shares. Okay. So therefore, contract entered on 1st March. Entered on 1st March, not 1st March, sorry, 10th March 20x1. Settlement on 10th April 20x1. The question is this going to be regarded as a liability or equity? What do you think? What do you guys think? Okay. What is the settlement condition? Such number of shares at rupees 10 to equal the price of gold on 10th April 20x1. Okay. This is the settlement contract. Such number of shares. Okay. So now tell me, what is this contract leading to? Is it giving me a financial liability or is it giving me equity? Financial liability, absolutely. See, the seller is getting protected from everything. When is the settlement happening? We have done this question again, but in a different manner. The settlement is happening on a future date, 10th April. The seller is demanding you pay me in the form of equity shares. Agreed. How many equity shares? Depending on the price of gold, which will be there on 10th April 20x1. And if that is the case, then the seller is virtually protected from all. I repeat, the seller is protected from all movements in equity shares because he is getting that many equity shares as is the value of gold. So he is getting exact equal amount to the value of gold that he is going to sell on 10th April. So seller's position is protected, and seller's position is protected means what? The burden is entirely on the issuer of equity shares because this is not fixed for fixed. The number of shares is not fixed. Why is the number not fixed? Because the price of gold is not fixed. Why not fixed? Because it is based on a future price. Do I know the future price? Answer is no, I do not know the future price. And therefore, this whole uncertainty is there on the head of the issuer of equity shares, that is Silver Limited. And therefore, for the books of Silver Limited, this transaction will be regarded as a financial liability. To be specific, to be more specific, this will be a derivative financial liability. This will be a derivative financial liability. Why derivative financial liability? Why a derivative? You are entering into a contract today. Yes, I am entering into the contract today for settlement in the future. Yes. Is there an underlying asset? Yes, there is an underlying asset, that is value of gold. If the underlying asset is fixed, if the underlying asset is there, settlement happens at a future date. Today you are not paying anything. Okay, so all the three conditions are met. It is going to be a derivative. And since you are settling in variable number of equity shares, it will be a derivative financial liability. It will be a derivative financial liability. If the price is fixed on the first day itself, okay, 10 grams of gold or 10 ounces, jo bhi bolo, let us say the price of that is 50,000 on 10th April. Let us assume I modify the question and say that on 10th April 20x1, you have to pay me 50,000. This is the price of the gold. This is the price that I am fixing today. You can get the delivery later on. You can get the delivery later on, but I will be collecting 50,000 only from you. So now tell me, are you fixing the price? Yes, the seller is fixing the price. That means, will the seller be able to get the benefit of a price increase from 10th March to 10th April? Answer is no, because he is fixing the price. If he is fixing the price, today, settlement happens in the future, price is fixed today, issue price of shares is given at rupees 10. Issue price is 10. So what happens is X number of shares into rupees 10 per share is equal to 50,000. That means there is only one number which is possible, that is 5,000 shares. So in effect, what is this contract looking at? This contract is looking like 5,000 shares for 10 rupees. So fixed number of shares, fixed number of price, and that is how you are going to evaluate. That is how you are going to evaluate the contract. Okay. So I am settling, Silver Limited is settling this contract by issue of own equity instruments. And in the issue of own equity instruments, Silver Limited is issuing a fixed number of equity instruments at a fixed price. So therefore, there is no further price implications on Silver Limited. The seller is going to bear all the burden because he has fixed the price on the first day itself. He has fixed the price on the first day itself. So therefore, any fluctuation thereafter, the seller is going to bear the consequences, not Silver Limited. And therefore, it will be an equity instrument. It will be an equity instrument. A derivative contract nonetheless. It will be a derivative contract, but a derivative equity. It will be a derivative equity. Is it okay? Yes. Did your query be determined, Namrata? Yes. So Kaushiki's answer is right. So the question is done. Okay. So as of now, is it a derivative? Yes. There is an underlying. So this is the underlying value of contract changes. No net investment settled at a future date. When I say no net investment, I mean no initial payment or insignificant initial payment. So it is a derivative contract settled in own equity other than exchange of fixed amount of share, fixed number of shares for fixed price. So therefore it is classified as a liability. Therefore it is classified as a liability. So illustration 6 also is done. Okay. All right. Are you able to connect the dots? Important point. Shriram, Janvi, Namrata, Kaushiki, who else is there? Viraj, Panu and Nikita Werneker. Are you able to connect the dots? The whole point behind doing so much detailed discussion on the assets and liabilities, financial asset, financial liability, equity, is because I want you to connect the dots now and get me the discussion on whether these particular contracts are financial assets or not. If you are able to connect the dots, what we have been discussing since the past 3 days is definitely successful. Okay. All right. So that takes care of illustration 6. Let us look at some more questions. Okay. All right. Illustration 7. B Limited writes an option. Writes means sells an option for sale of Target Limited at a fixed price of 100 rupees per share to C Limited. Okay, fine. This option is exercisable anytime for a period of 90 days. Evaluate this under the definition of financial instrument. Evaluate this under the definition of financial instrument. Okay. So now let us look at the contract. Let us look at the contract. And this is very important, very interesting. Okay. So I have B Limited. I have C Limited. B writes an option. So B is the option writer. Writer means B is going to sell. C is going to buy. So C is the option holder or option buyer. Okay. So now what you will have to do is evaluate this under the definition of financial instrument. Kiske books mein hai, they have not mentioned. In whose books they have not mentioned. But if you read the solution, they are saying that it is in the books of B Limited. So we'll just write this. Evaluate this under the definition of financial instrument in the books of, we'll do both in the books of B Limited and C Limited. Okay, let us do both of them. Okay, so you get a wholesome, and we'll do something extra also. Okay, so B has entered into an option contract with C. Okay, what is the deliverable? Shares of Target Limited. Shares of Target Limited. Okay. 100 rupees per share writes an option contract for sale of shares. Okay. Sale of shares at rupees 100. Okay. At rupees 100. All right. Or sale of shares means I will assume that it is fixed shares. Okay. Because they have not given variability anywhere. Okay. Sale of fixed number of shares at rupees 100, at rupees 100. And now you have to decide what is this contract. So in the books of C Limited, what is this contract looking like? What is this contract looking like? Come on, tell me now. Tell me now. Books of C. Books of C Limited. What is this contract? C Limited has the option to buy shares of Target Limited at rupees 100 from B Limited after 90 days. After 90 days. So the first thing is it a derivative contract? You will have to ask yourself 3 questions. What are those 3 questions? The first one is there an underlying asset? Yes. So will the option value change because of that? Answer is yes. Okay. The second one is there any initial net investment? Answer is no. There is no initial net investment. And last one is, will it be settled at a future date? Yes, it is going to be settled at a future date. So my question is it a derivative? Answer is yes, it is a derivative. If it is a derivative, it could be a derivative financial asset, it could be a derivative financial liability, or it could be a derivative equity. Any of these 3 is possible. So what I want you to answer is it a derivative financial asset or is it a derivative equity from the perspective of C Limited? So I got the answer as financial asset. 2 of them have answered. Why not equity? Why it won't be equity? You are able to see a fixed number at a fixed price. So why not equity? Come on, tell me, why won't it be equity? हमने पढ़ा था ना, any contract that meets the fixed for fixed requirement, any derivative contract meeting the fixed for fixed requirement should be a derivative equity. What do you guys think? Should it be equity? We are meeting fixed for fixed test, no? Yes, we are getting guaranteed value and guaranteed number of shares. So why not equity? Why financial asset? But here they have given a fixed price, no? They have said sale of fixed number of shares at rupees 100. B Limited has contracted that you will sell the shares at rupees 100. How many shares? That is also fixed. It's not given in the question, but it is fixed because they have said sale of shares. They have not used the word sale of such a number of shares. So number of shares is fixed. Price is fixed. So therefore, how do you know there is no residual interest? If I buy the number of shares, there will be a residual interest. Why not equity? It is a derivative contract meeting fixed for fixed. Why not classify it as equity? Why are you classifying it as financial asset? Price is fixed, number is fixed. And we have studied that any derivative contract which meets the fixed for fixed test should be classified as an equity. You have to understand. Look at the definitions, my friends. We are forgetting the definitions. Itna sab karne ke baad, we should not forget the definitions. Okay. What is a financial asset? Open karke dekho. A contract that will or may be settled in what? Will or may be settled in entities' own equity instruments. Own, khud ke share, own equity instrument. In this particular case, is it settled in own equity instruments? Answer is no. It is not settled in own equity instruments. If it is not settled in own equity instruments, it cannot be equity at all. It is only going to be a financial asset. Dusra kuch mat dekho. It will be a derivative financial asset. That's it. It is not happening in settlement in own equity. It is settlement of some other company's equity. And if it is settlement of some other company's equity, it will be a financial asset to me. It will be a financial asset. Acha, tell me one thing. Same question, shares of Target Limited, but variable number of shares or variable price of shares, or both are variable shares or price. Yes, in this case, what is it going to be? Sir, in this case also, it will be a derivative financial asset. In this case also, this will be a derivative financial asset, because you are settling what? You are buying other entities' shares. You are buying other entities' equity instruments, and therefore, this contract will be a derivative financial asset. Whether it is fixed for fixed, whether it is variable price, whether it is variable quantity, whether it is variable price and variable quantity, kuch bhi ho jaye. You will look at the definition of derivative, non-derivative in financial asset only if the settlement happens in own equity instruments. If it happens in other entities' equity instruments, we fit in the first three clauses of the definition. Financial asset is a contractual right to receive cash, another entity's equity instruments, okay, or another financial asset. So you are having a contractual right to receive Target Limited's equity instruments. There is no fixed for fixed, variable for variable in the first three clauses. The fixed for fixed test only comes if the settlement happens in own equity instruments. And that is why, my friends, here it is going to be a financial asset. Here it is going to be a financial asset. Okay, so this is what it is going to be. If we are doing the accounting in the books of B Limited, you tell me what this is going to be. B Limited is entering into a contract to sell a fixed number of shares at a fixed price of Target Limited. So tell me, for B Limited, will this contract represent equity or will it represent a financial liability? Again, go to the definition. B1 and B2 of financial liability definition tells that any contract that will or may be settled in the entity's own equity instruments, if it is a non-derivative variable, if it is a derivative other than fixed for fixed. So therefore, there also, if the settlement happens in own equity instruments, only then you are going to look at what? Fixed for fixed test. If the settlement happens in shares of other entity, wo fixed number, fixed price, variable number, whatever be the scenario, we just have to say the settlement is happening in the equity instruments of another entity. And since it is happening in the equity shares of another entity, this will be a derivative financial liability. Absolutely right. You have an obligation to deliver the financial asset of another entity. There we don't check whether it is fixed for fixed, variable, etc. We don't check that. We only check that we are delivering another financial asset. What is that other financial asset? Equity instrument of another entity. So therefore, we are going to classify this as it is. Acha, when you present the answer, classification to aapne kar liya, but you have to also tell under which clause it goes and sits as a financial asset or a financial liability. So here you can say that first one, it is a contractual right to receive. financial assets. Contractual right to receive financial asset. Yes. So because if the option is exercised, C Limited is going to get equity shares of Target. And if it is getting equity shares of Target, it meets the definition of the financial asset. So you can say contractual right to receive financial asset. Or the more appropriate classification would be, it is an option. It is an option. So this is a contract where there will be exchange of financial assets under conditions potentially favorable to C Limited. It will be under cases where it is potentially favorable to the holder of the option. So therefore, in this case, you can also say that it is a contractual right. It is a contractual right to exchange. What are you exchanging? Financial assets or financial liabilities. Financial assets or financial liabilities at potentially favorable terms. At potentially favorable terms. If you remember, I had discussed with you an option contract is always favorable to the option holder because the option holder has the right to exercise. He will exercise depending on what? He will exercise depending on whether it is favorable for him. But for the option writer, it is always unfavorable. It is always what? It is always unfavorable. The loss is unlimited for the option writer, whereas for the option holder, the loss maximum that he can suffer is the premium paid on such equity contract, on such derivative contracts. Is it okay? So therefore, this is a contractual right. This is exchange of financial instruments at potentially favorable terms, at potentially favorable terms. Okay. As far as B Limited is concerned, what can we word it as? Contractual obligation to deliver cash or other financial assets. Okay. Or what you can say is contractual obligation to exchange. What are you exchanging? Financial assets or financial liabilities. In this case, it is financial assets under potentially unfavorable conditions or unfavorable terms. Okay. So you don't have to only say that it is a derivative financial asset or derivative liability. Array, explain under which clause it fits in. You don't have to reproduce the clause as it is. You can write in your own words, but please ensure that you write. Okay. So this is a contractual obligation to exchange financial assets under potentially unfavorable conditions. Under potentially unfavorable conditions. Is it okay? Yes. Did you understand? Any doubts so far? Any doubts? Any doubts? Polo yaar, any doubts? कौन सा illustration है? Illustration 7. Illustration 7. No doubts. So if the contract is for shares of Target Limited, which is exactly the question, this will be a financial liability for B Limited and this will be a financial asset for A Limited. We saw under which clause it is settled. Okay, now B. This is extra. Shares of B Limited. Shares of B Limited. Extra. Achha. Now tell me, B Limited has entered into a contract to deliver its own equity instruments at a fixed price for a fixed quantity. For B Limited, what will this contract be? For C Limited, what will this contract be? Yes. B Limited, C Limited. I'll come to your query, Namrata. Okay, I'll come to your query. Okay. B Limited, C Limited. Okay. Now, you tell me shares of B Limited. So, B Limited has entered into a contract to deliver its own equity instruments for a fixed price, a fixed quantity. So, now for B Limited, what it will be? For C Limited, what it will be? Look at the definition. A financial asset definition. A contract, if it is being settled in own equity instruments. If it is being settled in own equity instruments. Okay. So now B Limited, you are delivering shares of B Limited. So own equity instruments किसके लिए हो गए? It is own equity for B. If it is own equity for B, then the contract is fixed for fixed. So this is going to be equity. Why equity? You are meeting the fixed for fixed criteria here. You are meeting the fixed for fixed criteria here. B is giving its own equity instruments to C at a fixed for fixed contractual terms. And therefore, for B, it is going to be equity. Whereas for C, it is not the own equity of C. It is not the own equity of C. It is another entity's equity. It is another entity's equity. So therefore, it continues to remain a financial asset for C Limited. It continues to remain a financial asset of C Limited. And coming to the last one, shares of C Limited extra. Shares of C Limited extra. Shares of C Limited extra. So now, what is B Limited writing? A contract to give equity instruments of C Limited. Who is C Limited? Another entity. B Limited is not giving its own equity instruments. B Limited is giving another entity's equity instruments. So therefore, this will be a financial liability, not equity shares of B. You can write here, not equity shares of C. Okay. All right. So it will be a financial liability for B Limited. For C Limited, it is a contract that will be settled in its own equity instruments, and it is meeting the fixed for fixed test. And therefore, for C Limited, what it is going to be? Sir, this is going to be equity. Why? It is meeting the fixed for fixed test. It is meeting the fixed for fixed test. Is it okay? Yes. Are, have you understood the definition correctly? Bolo yaar, did you understand? Yes or no? Yes. Are you finding it interesting now? बहुत थियरी हो गया, 3 दिन से पका रहा हूं तुम लोगों को. Are you able to follow? Yes. 3 दिन से हम लोग वही चीज गोल गोल घूम घूम के पढ़ रहे हैं कि फाइनेंशियल एसेट क्या है, फाइनेंशियल लायबिलिटी क्या है, इक्विटी क्या है, व्हाट इज दिस फिक्स्ड फॉर फिक्स्ड वेरिएबल. इज इट नाउ एबल टू मेक सेंस टू यू? Yes. Are you now able to understand how we view the contracts? Yes. Okay. So that is the meaning of, that is the solution to this question. We have done this question also now. Let us then move on to, okay, when you do the questions, please ensure that you write the page numbers also. Okay, because we are flipping across chapters. We are running across chapters. Okay, so therefore, please ensure that you write the page numbers also, so that when you do the revision at some point of time in the future, which you will do. I have no doubt about that. You should not be stuck unnecessarily. Okay. All right. Okay. Okay. 16 nahi re, 14. Illustration 15. Page 1.0, page 102. CBA Limited issues convertible debentures to RQP Limited for a subscription amount of 100 crores. These debentures are convertible after 5 years into equity shares of CBA Limited using a predetermined formula. The formula is 100 crores into 1 plus 10% raised to 5 divided by fair value on the date of conversion. Divided by fair value on the date of conversion. Examine the nature of financial instrument. Examine the nature of financial instrument. Okay. So now this is illustration 15. Page 12.102. Okay. CBA Limited. And दूसरा कौन है भाई? RQP Limited. Okay. It has issued convertibles, convertible debentures. Convertible debentures. Okay. All right. All right. Fine. Number of shares is equal to 100 crores into वो जो भी है 100 crores into 1 plus 10% raised to 5 divided by fair value on date of conversion. On date of conversion. Okay. So now you will have to tell me. Now you will have to tell me whether this is going to be equity or a financial liability. First, we start with books of CBA Limited. Books of CBA Limited. Books of CBA Limited. What do you think? What do you guys think? How will CBA Limited classify this instrument, that is the convertible debentures? क्या लगता है आपको? Is it going to be equity or is it going to be financial liability? Excellent, Kaushiki. Others, Namrata, Jahnavi, please think and answer. Nikita, Shriram, are you guys there? Tushar, Viraj, are you guys there? Panu. Shares of CBA Limited only. Convertible debentures, that is what they have given. Na? Issues convertible debentures, तो खुद के शेयर ही इश्यू करेगा. Into equity shares of are convertible into equity shares of CBA Limited. Okay. Number of shares of CBA. Own shares. Yes, that's right. So now tell me, what is it going to be? What is it going to be like? Good, good. That is how you should do. Okay. I got one answer saying it is equity as it is own shares. Again, you look at the definition. Financial liability, settlement in own equity shares, non-derivative, then it should be variable. Derivative other than fixed for fixed. So therefore, whether it is a derivative contract or a non-derivative contract, the exchange should be variable. So now in this case, is the number of shares getting fixed? Is the number of shares getting fixed here? 100 crores into 1 plus 10% raised to 5 divided by fair value on the date of conversion. Conversion is happening after 5 years. Conversion is happening after 5 years. Do I know the value after 5 years today? Answer is no. मेरे को तो नहीं मालूम. If I don't know the value after 5 years today, I will not know how many shares should I issue. What is the price of that? So neither is the price fixed nor is the quantity fixed. So therefore, is it meeting the fixed for fixed criteria? Answer is no. But wait, is the settlement happening in own equity instrument? Answer is yes. Settlement happens in own equity instruments, but it is not meeting the fixed for fixed criteria, and therefore this ends up being a financial liability for CBA Limited. For CBA Limited. Why this is the whole problem arose? Because this is fair value on the date of conversion. Conversion happens after 5 years. If it were to say fair value on the date of issue, the date of issue of debentures, if we say that, then date of issue of debentures is today. Today itself, I know what is the fair value. So today itself, I know the number of shares which I will issue. And therefore, is the fixed for fixed criteria being met? Answer is yes. And if that criteria is being met, it would have been classified as equity. But because we are talking about fair value on the date of conversion, that is why we are going to treat it as a financial liability. For RQP, books of RQP Limited, books of RQP Limited, उसको क्या फर्क पड़ता है? You give a bond or you give an equity. For this fellow, this contract is always a financial asset. For this person, the contract is always a financial asset. Is it okay? Yes. Sure. Are you able to follow? Bolo. Yes. Janvi, you got it? Yes. Okay. So that takes care of settlement in entities' own equity instruments. Okay. All right, fine. So what I want you to do is, tomorrow itself we have a class. Just go through this illustration 16 for homework. It is very simple. Okay. Please, mere ko na, don't put me down. Okay. Please do it by yourself. Okay. I want you to try illustration 17 also. That is also what we have already done. It is similar to that target limited question which we did. So you should be in a position to understand that. Okay. Okay. All right. Fine. Then that's it. So that's it for today. Tomorrow what we will be doing is we will be picking up certain exceptions to the, इतना सब करने के बाद life थोड़े ना आसान होता है यार. Once you gained confidence on these things, then life cannot be so simple. Na? There will be exceptions to the variability. That means even if they do not meet the fixed for fixed test, there are 3 cases where it will be regarded as equity, even though the fixed for fixed test supposedly fails. So tomorrow we will look at those cases and then we move on to classification. Okay. You will have to unfortunately look at the remaining questions by yourselves, because if I start doing all the questions, हम लोग 10 दिन सिर्फ definition में ही अटके रहेंगे. Okay. But we have a lot to do. Miles to go before I sleep. Okay. So we will do that later on, and we shall wind up. Tomorrow we'll take the exceptions and then we move on to classifications. Okay. So that takes care of today's class. Thank you everyone, and stay safe. See you guys tomorrow. Okay. We have 4 classes in a row. I want to do quite a number of topics with you. Okay. All right. Thanks everyone. Thank you. Thank you. See you. Take care. Yes. Oh, yeah.